Well, thank you very much. Thank you very much for the opportunity to participate in the symposium. And I think it's a great thing to see some rapprochement, if you like, between academic research and practitioners. And indeed, what I'm going to talk about today bears, if you like, on that relationship between academic research and what the industry does. To do so, I'm sorry to say I'm not going to have a PowerPoint presentation. Now, some of you may be grateful, some of you may be surprised, but nonetheless, basically I'm going to talk through a series of arguments about the topic, and the topic was basically how the governance and management of investment institutions might match, if you like, the aspirations that go with it. Before doing so, I think it's worth sort of rehearsing a little bit about the research that we've been doing over the last 10 or 15 years. One has been in the area of investment decision making, looking particularly at groups of individuals, particularly, if you like, in this context, in this room, looking at clients, that is to say, pension funds, insurance companies, sovereign wealth funds, and the like. So we've been very interested to see actually how that decision-making process amongst groups frames, implements, executes investment strategy, and if you like, what are the advantages and disadvantages of different setups. So large groups, small groups, expert groups, amateur groups, you know, what's the payoff, if you like, for different configurations of how you manage yourself. And it's not surprising to find that in many respects experts do better than amateurs. We know that pretty fairly generally, but it's also very important to understand, even amongst experts on boards, how they look at themselves and how they judge one another's, if you like, expertise. So it's not just a trust question, it's a question of valuation, if you like, of other people's judgment. We've also looked, and I won't talk that much about that today, about individual decision making, particularly in what you'd call in the US context a 401k context, or in the Australian concept the super concept or context, and of course in the UK a defined contribution pension plan. We've also been looking particularly at research on, as I say, the governance and management of investment institutions, and it was mentioned that we've done a lot of work on major sovereign wealth funds, but also pension funds, insurance companies, and there the governance of them, the management of them, that is how they basically are organised as institutions. And finally, and I'll sort of mention a little bit more about this when I come on and talk about a couple of instances, research on the structure and performance of the investment management industry itself. And that's actually what I want to spend some time talking about, because in a sense I want to rehearse some of the arguments that have been made in the UK recently through the K review of the investment management industry. And I was involved somewhat in the K review, partly, I think, to add a different opinion, but also partly to bring the expertise that we've developed on governance and management of institutions. Second thing to say, sort of by way of background, is all this translates into models of best practice. So we've been trying to go from the research side of the equation to models of best practice, how you set up these institutions and how you run them, how you make them effective, if you like, in the context in which they are embedded. And one of the things that we've sort of really argued is about how government investment institutions, for example, how embedded in a government agency or embedded in a government milieu, how that affects basically the control and management of these institutions. What level of knowledge, if you like, should be on the client side as opposed to those who are charged with executing the mandate that comes with the government fund. We've been also very interested in and concerned with how the, if you like, governance and management capacities of institutions match, if you like, the risk that they've either consciously or not so consciously assumed, and whether or not actually the mismatch, if you like, between the governance capacity of an institution basically takes them into worlds in which they don't understand, and indeed the types of risks that they're unwillingly assuming. That, I think, is a very important element, partly because some types of funds are simply vehicles for managing liabilities, where some other kinds of funds are actually vehicles for investing in a long-term basis, which in the long term spreads over whole generations. We've been finally very interested in short-term, long-term. How do you go from the world of markets, if you like, which look like short-term, to actually realising long-term objectives? How do you design an institution that is self-consciously long-term, given in fact much of the industry is so short-term? And for my sins, I've had to do this personally in the sense that I'm on 3 investment boards at Oxford, which have given me a great insight both into academic research, but also into my academic cousins and brothers and sisters. Not always a great experience, but nonetheless, it's probably not the right occasion to comment on that. More specifically, we're involved in a recent review of the Swedish Ap System. The Swedish government has 5 separate funds, each running about 20 billion or 25 billion euro, or let's say euro equivalent, and those funds effectively manage the long-term liability of the underlying public pension system. And we were asked to basically ascertain the effectiveness and management capacity of each fund and make recommendations about how you'd collapse 5 into 1. Not an easy proposition when the politics say that collapsing 5 into 1 is not palatable and otherwise. Okay, so, and as I say, we were very involved recently in the K review, and this is basically going to be my topic today, elements of the K report. It always strikes me incredibly, an incredible fact of life, actually, when I talk to audiences in Australia about your ability, and I must say it's a wonderful thing, to talk about the global financial crisis in the past tense. It's past, it's gone, we're sort of gone beyond that and we're not really worried about that. If only that was true, at least in my life, the UK and most particularly Europe and the United States, we not only have the remnants of the global financial crisis with us every day, we also have the Euro crisis, which basically has fundamental consequences, I think, for the prosperity of Western democracies. So to talk about the global financial crisis that's gone it may ring true in an Australian audience, but trust me, it doesn't ring true everywhere elsewhere. And in that context, the fact that the global financial crisis and now the Euro crisis is so profoundly important for the welfare of whole countries in Europe, including the UK, the UK government constituted the K review to basically ascertain the social value of the investment management industry. The question posed was fairly simple. To what extent does the investment management industry contribute or add to social value? In particular, to what extent does it aid the long-term development of the UK economy? To what extent is the UK fund management industry an effective entity in governing UK or resident corporations, corporate governance question, and to what extent is it consistent with the underlying commitments of insurance companies, pension funds, and other bodies that have, if you like, a long-term perspective either in terms of the liabilities they have immediate available to manage, or at least the long-term social welfare of society. Not surprisingly, Kay responded to these questions on the negative. I mean, to understand why is to understand John Kay a bit. He was chosen because he is a contrarian, right? He is not, if you choose somebody like John Kay, you know the answer you're going to get. He's going to say that it has not aided the long-term development of the UK economy. He is going to say that it is a very poor governing device on our major corporations. He is going to say, basically, it's inconsistent with the long-term interests of most financial institutions that have long-term obligations. Nonetheless, he did it in two different ways. For example, he didn't say that actually financial markets are bad things in the sense that they don't aid price discovery. It was a very interesting sort of moment actually in deliberations where this issue was raised amongst some players in the room, whether or not it was a good thing that financial markets are useful in this price discovery process. And he was affirmative. And indeed, I thought the research talked about price discovery this morning actually aids actually a lot of that discussion. And I think we all, and I say society at large, has an interest in effective and efficient price discovery. Nor did Kay dispute the costs of the investment management industry itself. It wasn't that he was saying that actually it's too expensive or it's too, it's basically ripping off, if you like, a large share of the underlying client value. That wasn't the argument. But what he did give was short shrift to the efficient markets hypothesis, modern portfolio theory, and very much else of the configuration that goes, if you like, with what we've inherited from for the financial theory. I say that actually, someone paused the other day when I said this sort of glibly. I said, well, out goes the door, efficient markets hypothesis and diversification effectively, and people sort of, some finance professors basically paled. But it was a very interesting moment actually in the deliberations of the review where the issues were discussed for 20 minutes and passed on basically without debate as basically being inconsistent with how we might characterise how markets actually work. So what was his diagnosis? Why is the investment fund management industry so problematic in his world at least? One explanation is intermediation. Intermediation in financial markets are taken to be, if you like, a mark of the sophistication or maturity of a financial industry. That is, more and more players providing more and more specialist services linked together, if you like, in a value chain that is coordinated through sets of contracts that overlap and integrate through from the client to the outcome. So that the argument about the maturity of a financial system is actually the depth of intermediation and the range of specialised services available. The Kay review basically says intermediation is a problem. It's a problem in part because there are opportunities for expropriating value by an individual sets of, if you like, parts of the chain. But more particularly for Kay, intermediation is a problem because it absolves anybody, everybody, for responsibility for the sum result of each element in the chain. The argument is actually no one is responsible in the end because everyone is basically part of an element of a chain that adds up such that in the end the client holds the end of the result rather than any element in that chain. And this is particularly a problem when clients are themselves poorly equipped either to govern the chain of intermediation or in fact actually make good on any shortfall that comes with that chain of intermediation. And that's actually that's an indictment, if you like, of the client capacity, if you like. The client is partly trapped in, according to Kay, this chain of intermediation. The second argument that he makes, and I think is widely shared, is that fiduciary duty, which is the touchstone governing intermediation, the touchstone governing behaviour in the process of managing value, the production of value. Fiduciary duty inherited from common law, inherited from past practices, really going back to the Middle Ages in the UK, fiduciary duty now doesn't serve a purpose. And in fact, actually, Kay would argue that fiduciary duty legitimises maximising short-term returns as actually the litmus test of effective fiduciary duty behaviour. That in fact what it needs to be done, the definition of fiduciary duty needs to be redefined such that it shifts away from the maximisation argument on short term to actually thinking about what can be achieved over the long term. So that actually to redefine fiduciary duty is to talk actually about the time horizon over which you would judge behaviour and you would judge outcomes. And that is to shift the industry and the production of value from short term to long term and then value each element in this chain of intermediation against that long term criteria. Now, I must say I am in print basically arguing that this is either a good thing, it's a good thing, of course the long term's a good thing, who says it's not a good thing, but I think he was rather misplaced in some respects in the sense that I, personally, sitting as a trustee of a pension fund with a lot of liability in play, when people talk to me about fiduciary duty, which I take personally, trust me, very seriously, the fact of the matter is my ability to exercise fiduciary duty is constrained actually by a series of regulations placed upon me by the pensions regulator, by the Financial Services Authority, that constrain actually my activities there when actually I ought to be working over here. So it's really quite quixotic in some respect to criticise fiduciary duty or its current interpretation and call for the government to redefine it when actually the government over there has redefined it so as to constrain my activity. But nonetheless, this is one of the bedrock arguments. And remember, in the UK, to be qualified as a fiduciary is still to have the expertise and competence of an average person. Whereas when you look actually towards the United States and ask questions about what is the federal definition of fiduciary duty, it has a higher standard of terms and reference in terms of a professional competence than what the UK standard requires. In a sense, actually one of the problems in the UK is that we have amateurs acting as fiduciaries. Equally, we are constrained in how we exercise our fiduciary duty by regulations on another side of the ledger. The third argument or diagnosis of the problem for Kay was portfolio diversification. Basically, as I said before, he sees intermediation as results in effectively nobody being responsible. The complex logics and otherwise of fiduciary duty, if reduced to short-term maximisation of outcomes, again basically constrains the effectiveness of the industry. But he, in the end, says it's portfolio diversification that's the problem. In a curious way, he goes back to Keynes' 1936, and Keynes, if you remember, famous for managing the finances, I guess, of King's College, Cambridge, on the back of a handful of funds. And John Kay, loving John Maynard Keynes, thought that actually the trouble with portfolio diversification, it might be 100 stocks, it might be 1,000 stocks, or in the case of Australia, which I take your point quite clearly, it might be 300 stocks. But once you get out beyond 50 stocks, let's say, or even 100 stocks, the capacity to actually judge behavior, judge value, actually goes out the window. And what you're left with, which is to say not a bad thing, but what you're left with are models of behavior, models of performance, models and criteria of performance, rather than actually knowing the elements that make up your portfolio. Now, I sort of say this in sort of bold terms because I want to come back and sort of pick apart this argument somewhat. But basically, he thinks the UK economy has not been served by a fund management industry that has no knowledge of the underlying portfolio, has no knowledge of the stocks that make up a diversified portfolio, and that he thinks that the value for the UK economy has been lost as according. Now, I think this is also somewhat quixotic in that if you're a relatively small fund, you know, say £1 billion, I dare you to go out and find 26 stocks or 50 stocks or 100 stocks and do due diligence on those stocks and come back and tell the Board of Trustees what you found and actually whether this is a good portfolio or a bad portfolio relative to another 50 stocks or another 100 stocks. I dare you to do that. That is actually both incredibly expensive in time, but it's incredibly expensive in expertise. And who are you going to do that? Well, clearly in a fund that's running at £1 billion can't afford their own people to do it, so you're going to have to hire, guess what, a fund manager, and they're going to be quite specialised, so we're back into the chain of intermediation, which he doesn't like. Now, his argument is, well, that's just because, and I think this is very clear, at least in the UK case, this is a problem of size. The fact is most clients are too small relative to the large players. Now, you all might say, oh, look, the fund management industry is incredibly diversified. We've got large players, small players, tons of players. But in fact, actually, in the UK at least, I don't know in Australia, the concentration of assets in just a handful of asset managers basically means it's an oligopolistic structure of which the small players are simply elements, if you like, in a much bigger ecology. So, in a sense, the whole logic of it is actually small funds ought to be big funds. That in the end, what we have to do is size up, if you like, on the client size equal to the size on the supplier side. Now, doing that means basically me giving up my role as a trustee on a relatively small pension fund and basically adding it into another really big fund. Now, I'm more than willing to do that. I'm just an academic after all. But trust me, not everyone on my fund is as enthusiastic, and I haven't been able to convince them to basically go out of business just yet. Okay, so two things to say about this. Kay's not alone in these types of criticisms, and indeed, if you pick up any book at the moment that comes from the US from leading academics, there are two things in those compilations of essays that are argued. One is the fund management industry or investment management has destroyed value rather than created value over the last 10 to 15 to 20 years. And indeed, actually, we've been incredibly complacent in assuming that what was, as someone might have said, a regime, a period of time where stability held, is going to be the same world going forward. That actually the criticism of the industry is about basically its complacency and its inability to add value. Furthermore, one of the implications that go with this type of analysis is to look far more closely at the relationship between clients and providers. If you're going to reduce the chain of intermediation back from, let's say, and I've seen in some big funds, 40, 50 service providers of different kinds. In fact, in one of them, I asked them, who in this room has read the contracts that basically bring all these intermediaries together? And trust me, no one had read the contracts. In other words, they were as ignorant about the contractual relationship binding themselves with the service providers as they were ignorant, in fact, actually, about the relative performance of one one element in the chain of intermediaries. So one of the consequences of this question about intermediation is asked more carefully, how many intermediaries? And then the second question is, and how should we govern those intermediaries? What should be the contractual basis that basically binds their interests and our interests together? And indeed, what is the nature of contract that we've inherited from the past? Now, that actually has turned out to be quite an odyssey. I've been going around the world trying to read other people's contracts. On that subject, and my academic brethren will understand, this is actually a challenge, because one of the things that most contracts in the investment fund management industry says, A, they are confidential, and B, you can't disclose terms to a third party. I'm a third party, right? So I've been sort of reading contracts on the sly. What I found is three types of contracts. One I'll call passive and permissive. It's not an effective framework to govern client investment management relationships. All it has is a nuclear option. That is, if we're really pissed off with you, we'll fire you. Right? Passive and permissive. Passive in the sense it's not an effective governing device of a relationship between provider and supplier, or rather provider and client. And if you want to intervene in it, basically all you have is the nuclear option. That is, you can fire them. And you can fire them at will. Well, not really, because you have to give them notice, 30 days notice, and it might take 6 months to unwind, and the transition process also is expensive. I'm sure that's been explained to you when you actually want to press the button, but nonetheless, these contracts are passive and permissive. Passive on the client side, permissive on the supplier side. Another kind of contract is what I call precautionary, and that's to give it its somewhat of a nice idea. Is precautionary, that is, a contract is full of conditions. And the conditions are basically on issues like conflict of interest. Conditions are on issues like disclosure. Conditions basically that would embarrass me as a client should your actions as supplier come to attention. So these are conditions that basically bind the behaviour of the supplier, but are not actually about the goals and objectives that we want to achieve as the client. That is to say, we don't want to be embarrassed if it turns out a really big fund manager is investing in sub-Saharan Africa or the Sudan. We want to make sure they're not doing that. But there's no, if you like, structure, no, if you like, promotional aspect to the contract that binds the parties together in a shared relationship in terms of achieving certain objectives. And that's actually the rare type of contract you do find, the third kind of contract, which is what you might call promotional or long-term oriented, where actually the parties are bound together in terms of meeting and reaching mutual interest. But these contracts are not, these contracts might appear short-term, but they have a rollover function. These contracts are equitable in the terms of sharing benefit, right? These contracts are subject to review, not to terminate by the nuclear option, but all the time to basically try and accommodate the fact that we are living in a world where regimes of value switch radically time and time again. So these types of promotional contracts, I think, are very sophisticated items. They take expertise on the fund to govern, and that takes a great deal of attention. So you can only do it, really, if you have a short chain of intermediation. You've got to basically take it away from the 40 providers back to the 10, the 7, the 5 providers, and basically invest in that relationship through a promotional type of contract. Now, is this a sign of the times? I mean, I think passive and permissive kind of harks back to sort of, you know, the golden age. Remember when that was, maybe 15, 20 years ago, when, you know, equity markets would always go up. And of course, what do I know? They're going up at the moment. And maybe they'll always go up in Australia. But nonetheless, passive and permissive reflects basically complacency and a bygone age. Precautionary basically is a risk management model on the client side. That is of embarrassment, of basically being exposed for the actions of your provider. It is a political device, basically managing personal risk rather than an active process of governing investment. And as I say, promotional, being flexible, being adaptive, basically says what we're in is a world where being adaptive, being innovative, is going to be the touchstone of value going forward. And in that sense, actually, we have, I think, a framework to go forward. Finally, let me make 2 observations. One is that size matters, and, you know, it comes home profoundly when you review 5 basically equally sized funds and realise that actually this is quite an inefficient way to run a whole country's €100 billion budget for the future. Size matters. It's certainly not 25 billion. Is it 50 billion? Is it 75 billion? But size matters. Size matters a great deal, especially if you're going to have promotional contracts, especially if you're going to manage the relationship with your intermediaries, because it's expensive. You've got to distribute those costs somewhere else. Now, in the second sense, size also matters in a negative way, that very large funds, particularly in the public gaze, are subject to remarkable pressures, particularly in smaller countries. And it's noticeable, actually, when you go, not particularly to Australia, but other countries, the Nordic countries in particular. Size is really important. It's given them enormous economies of scale. Look at the Danish fund, look at the Norwegian fund, but actually the Norwegian fund is like Gulliver pinned down on a little island, with basically pinned to the point where actually its capacity to innovate is basically leaking away. So what's the bottom line here? The bottom line is, whereas intermediation may give us a system that basically allows us to run on automatic pilot, consolidation, that is bringing size to the client side of the equation, is terribly important. But institutionalization at a high level of size, particularly in the public gaze, may limit innovation and, worse, give us an inability to adapt to a very uncertain world. And as I say, the uncertainty I'm referring to is an uncertainty we live every day in the UK, Europe, where actually uncertainty about Greece's prospects is actually the uncertainty of the UK's prospects, which spills over, interestingly, uncertainty on the US prospects, because they are big investors in the future of Europe. So thank you very much.